Okay, everyone, thanks so much for joining. Let's get started. Just a quick note on our disclosure before we go. Here at Forex.com, this webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussions of a particular market or product herein should not be construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. This presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of this information or commentary provided. It will include references to actual past trading results for discussion purposes. Future options on futures, foreign exchange and other leverage products involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodity Exchange Act. Contracts for difference, or CFDs as they're also known, they are not available for US residents because of regulatory reasons. Okay, everyone, just bear with me one moment while I just get rid of this. Let me pull up my other charts. And we will get going. Well, it's been a really interesting week, obviously, since I saw you last. This week has been slightly quieter, as you can imagine. We don't usually see the level of volatility that we saw last week, but we are, still in the middle of kind of, the summer months for sure, and also, some unusual or a lot to digest, I would say, is the key thing to start with. And in that case, let me just organise this a bit better. Let's get cracking, really. And the first thing I want to show you is actually going to be my Bloomberg chart, because obviously a lot of what's going on at the moment, you'll have spoken to a lot of people about this, I'm sure you'll have read a lot about it. It's all really about the dollar. So in that environment, when it's always about the dollar, the first thing I like to look at is the dollar index. So the dollar index is the dollar against its largest trading partners, and that to me just gives me a really good sense of where things are going. So what we've seen here is the dollar kind of choke yet again at these kind of annual highs. It had reached the high of kind of above 84.5, which really opened the way to a multi-year high in the dollar index, but since then obviously it's pulled back, but yeah, it's starting to base. So what I'm finding here, or what this is telling me here, is that there's no real direction. That looks like a very, even though it's not a complete candlestick, obviously, it looks like, there isn't too much direction in the markets, as you can see, it's even flashing from kind of white to blue, so positive to negative, even as we are talking, and that suggests to me that there's not too much direction. And what we've really seen today, all in all, is a real push higher. So we've had the safe havens fall off, but then things like the Aussie move higher. We've got pound slightly weak now, euro mixed. So we haven't got any real direction. So all of this move that we saw kind of from middle of June, that massive push higher in the dollar, that's not necessarily being follow. We're not getting any follow through at this resistance level. That doesn't mean that we won't at the moment, but it just means that for right now what we are doing is just taking a bit of a breather. So the market very much taking a breather. There's a nice mix between buyers and sellers of the dollar, and hence we're not moving anywhere. Now obviously as well, it's not just about the dollar, is it? It's also about this thing here, Treasury yields. This is the 10-year Treasury yield. Obviously we had a much stronger than expected, or a stronger than expected, I shouldn't say much stronger, but a stronger than expected payrolls report for June. That was released on Friday. And we saw this huge push higher in the Treasury yield. It got to its highest level, let's go back 5 years. It got to its highest level since for over 2 years, and it got up to kind of 2.77%. Now, since then, it has actually backed off of those highs. The high was actually 2.75%. So my apologies there. It has backed off from those highs. It's dropped, around about 10 basis points, but it does seem to be basing nicely at 2.65%. Now, why is this? What is going on? Why is this? Why are we looking at this? Well, Treasury yields play a huge part in, what currency crosses do. Obviously, interest rates are a big driver of currencies, and they're a big driver of the dollar as well. So when yields are rising, it tends to be good news for the US dollar. However, in this case, we've seen a huge move higher in Treasury. So what does that actually mean? Well, I want to show you something. I'll show you something else as well in a moment. Just bear with me. Let me pull it up in my other chart. Right, bear with me one moment. Here we go. So this chart is another really interesting one. Now, it's probably one that some of you won't have ever seen before. It's the volatility of the 10-year Treasury yield in the US. And as you can see, it is enormous. It's at 26. I want you to remember 26 for one moment. Let's push back 5 years. And as you can see, highest level, again, for 2 years. Really, really strong move higher. And what you should notice here is that, by and large, the volatility in treasuries is actually quite low. It's quite moderate. So it's really pushed higher. It's anything but subdued now. And I think the one thing we need to take away from that is that, treasury yield volatility doesn't always last at these high levels. So it does take, if we're going to revert to the mean, like, efficient market hypothesis suggests that we should, then we should see treasury yield volatility fall off. So I want you to remember 26.5, because I'm now going to show you another chart, which is the VIX. And remember, the VIX index is the volatility of the stock market, and that is currently at 14.78. And what does that tell you? Well, what that shows you really is that volatility in the bond market has been much more volatile than the stock market, which is not usual. Remember, that is not that usual. But obviously, this is the environment where we're in with Fed tapering, Fed policy changes. We're seeing a lot more volatility in the bond market. So the bond market is really leading things. In fact, the average for this year in the VIX has been 15.33. Let's just compare that with the average for this one. The average on this has been 18.23, so actually it's been more volatile than the VIX of late, but the fact of that huge move higher, I mean, it's absolutely enormous. Someone's asked me to look at gold. Addy, I will look at gold, just bear with me one moment. But basically what I'm trying to say is that, treasury yields are, I think, at risk from maybe a slightly sharper sell-off, or for the yield, to fall back slightly, and treasury yields just to, the impact on treasury prices to just recede just a tad. So what we really see, and the reason why I say that is because we do have a FOMC meeting tomorrow. So one of the reasons why bond yield volatility has been so massive over the last certainly couple of months is because of uncertainty over the Federal Reserve. Now tomorrow we get FOMC minutes. I think they're going to be really, really important. They're going to be dissected for any type of detail about timing, size, scope, scale of this tapering program, of tapering from the Fed's QE program. So for me, because the market has been, incredibly aggressive at pushing yields higher, I think the risk is that Bernanke is actually slightly more dovish than expected, and so we see yields fall down. And that will have a big impact because yields, let me just make this into a chart really quickly so you can see it against the dollar. This is Treasury yields, and then I'll add the dollar index there as well. As you can see, Treasury yields and the dollar index very much moving in lockstep together. If they start to fall back, then what we could see potentially is, a deeper. If Treasury yields fall back, they could drag the dollar with them. So do watch out for that. Now, someone's asked me to look at gold. Okay, I'll look at gold now, and then I want to look at some of the majors because there's some interesting things going on. But there's also been interesting stuff going on in gold, and it's here. As you can see, gold had a bit of a nice recovery, but it's really consolidation, I think. I think it's just a bit of moving sideways before we embark on another leg lower. Now, I'm going to send you just a link quickly in the chat box. Just bear with me one moment, because I wrote about gold and why I think gold could potentially remain under pressure. for some time, and I put that in our, that's in our, you can see you can get our research here, so please do check our research when you get the chance, and you see kind of our longer term view on gold and why we think the fundamentals have really fallen out the bottom of it. But for this, this experiment, I guess, or this webinar, let's just take a look. That looks very much like a bit of a consolidation, period of consolidation, except there is a couple of things which could mean that this could be slightly more consolidation than we had expected. As you can see, we have got a bit of a series of higher lows, and then a kind of a flat top. So running into a bit of resistance here at 1260. If we get above here, then it opens the way to this 1310 mark. So what we could see is just a little bit of a bit more of a recovery, bit more of a pullback. I mean, again, I don't necessarily think that it's a bit of a bullish pennant. I think what this pattern is called, and there are so many patterns, but think of it a bit like a triangle. Basically, what we've got a series of higher lows, and when you get a series of higher lows, it suggests that potentially there are more buyers than sellers, and people are willing to pick gold up on the dips. We have heard just incidentally really and anecdotally that there is some good physical buying of gold ahead of 1200, and that is interesting because there's quite a lot of variation on what the production cost of gold is between kind of 1150, 1050, 1200. There's a huge amount of variation in that, but around kind of below 1200 you really get close to production costs for gold, so that makes gold look very, very cheap on a price basis, on a dollar basis as well. So that could be one of the reasons why 1200 is acted as very, very good support. So for those gold bugs out there, I would just point out that there could be a bit more upward pressure, but I do think gains will be capped in the next kind of few days. I think it's going to be really dependent on Bernanke. I think if Bernanke sounds slightly dovish or tries to temper expectations about the scope of tapering, of QE tapering, then we could get back to that 1310 level. These highs from kind of the 24th of June from a couple of weeks ago. Obviously 1362 there, that's the 50-day moving average. That's another big move, big resistance level on the upside. I definitely don't think, unless the Fed is to come out and say, no, we're not going to taper anymore. In fact, we're going to, continue our QE program indefinitely, then I think that could be what kind of propels gold higher. But I just don't see that happening. I also see, alongside tapering, we've also got some very weak inflation data. Now that could kind of work slightly in gold's favour, because it could mean that if inflation is weak, then gold, then the Fed may think twice about the scope of their tapering. However, you've got to balance that with the fact that gold is also an inflation hedge. So gold is weak, should be weak when inflation is weak, and that's kind of what we're seeing now. So as you can see, there's the potential there for a push higher, push above this 1260 level. But as I said, 1310 and 1360 are key resistance levels. But I think that a clear break of 1270 would be quite a bullish sign in this very, very short term to get us back to 1310. So that's our view on that. Now I also wanted to show you the pound. That's been a big mover this morning. I'm just going to show you the daily chart just to give you a sense of what's been going on. Nice recovery. Failed recovery. That big drop off here that we've seen, a drop of 70 pips on some weaker than expected industrial production data. It's quite a lot really. Industrial production data is released with a real lag. I mean, it's data from May. That's a very long time ago. Now it certainly feels a very long time ago. And it's, the PMIs were strong. So, what's going on? Well, it shows, just how sensitive the markets are to economic data released in the UK, how sensitive sentiment is. The market may like to believe that the UK economy is turning a corner, but they are not willing to allow any slip-ups in the economic data. Hence why we've seen what some may perceive as being quite a reaction, quite a bit, maybe even a bit of an overreaction to industrial and manufacturing data. We dipped below 149. Let me just extend this chart out a little bit. I'm going to put it on a daily. As you can see here, 148.70 has been the low so far this week, and then 148.30 is the low of the last 12 months. So, getting close to some very significant levels. And I'm not necessarily saying that I don't think the pound will, break that level and maybe make a new multi-month high, potentially back towards kind of, 14750, but I do think that possibly the pound has come too far too fast. I'm going to show you my other chart quickly as well. We just pull up the pound. Oh, that's not right. As you can see, as you can see here, looking very, very, very oversold. This is the relative strength index. I mean, it's at, like, it's below 30, and anything below 30 is considered oversold. On an hourly basis as well. Just got, again, a bit of a, once we got to kind of, above 149.50 to 80, it started actually looking like, the market was a bit stretched to the upside on the short term. So no wonder, really. I'd say that 149.80 now, 80 level is a bit of a reversal now. It is 149.80 looking like a big reversal for right now, and it's a bit of a double top that could cap gains for the medium term, for the very short term at least. So I am kind of aware of that. I do think 148.70 seems to be holding for now. That was that kind of big dip lower, and then obviously there is that 148.30 level, which is again another key support zone that we're going to be watching closely. So do watch out for that. Obviously, the market does respect prior levels. In terms of the pound, I think we're going to have to, obviously, this industrial production data is important, but it's really going to be the minutes from the Bank of England meeting released next Wednesday, the 17th of July. That's going to be the key driver for this, and I see it's kind of oscillating between kind of 148.30, maybe even 148 on the downside, and 150.50 on the upside between now and then, in the absence of any other kind of major event happening or breaking. That's how we see that. Okay, euro as well. I know a lot of you have been looking at euro. Obviously, some of you will have read that Greece got its bailout payment today. We've seen, a bit of a, that certainly helped to cheer the markets. But again, at around about the same time as the pound came off, we started to see euro falling back as well. So this 100-day moving average here comes in just below 129. It's acting as quite stiff resistance, and that could cap gains on the upside. Also, we were starting to edge into oversold territory there, overbought territory there, sorry, so no wonder. But again, there's quite a nice kind of channel here, which could kind of, lead us to range trade for a little bit in euro. Remember, there's no economic data today. Yes, Greece has managed to secure funds from the European Union. It's not going to default in August, but there are strict conditions with it, and the IMF actually isn't going to give its money to Greece, its bailout pledge to Greece, until it reaches more conditions. So it's not going to get those until August. Obviously, the conditions there are always quite politically tough. They include cutting thousands of public sector jobs, so that's kind of a key thing there. Euro sterling was another interesting one, and I just want to show you this quickly. Euro sterling, as you can see, it's had a nice reaction to what's been going on with the pound. So that sharp fall in the pound has pushed us back above 186. But the one thing I'd say about this is that 86.50 is really capping the upside, is potentially capping the upside. Now I want to show you another chart here, which shows you two things that are quite important about financial markets, forex market in particular. So this chart shows you euro sterling, which is the white line, and then the spread between German and UK 10-year bond yields. Now, as you can see, they've completely diverged. Now, they usually move in roughly the same position. It's not a fantastically close relationship, but this huge divergence, it has happened. It's kind of this part here, it looks like it's happened before, but it hasn't really, because they've been moving downwards together, they've been peaking at the same times, etc. This, divergence is quite severe and quite sharp. So it suggests that, euro is not being driven by its own interest rate differential with the UK, and instead it's probably being driven more by what's going on in cable, because obviously, the pound is a big, one of the reasons why the pound crosses move is because cable moves, because obviously that's the most traded pound cross. But what you can see here, that just leaves me slightly worried. And yes, we have pushed higher today, but as we said, kind of the 86 level, 86.50 level, and then also 86.50 is a big resistance, is obviously a big resistance zone. But let me just find another one. Bear with me one moment, guys. I'm just going to be pulling up another chart just to show you some key resistance levels. Okay. So as I said, the 86.50 level is a key resistance level that could cap the upside and could get us moving more in line with the interest rate differential. But then you've also got this massive level here. This comes in at 87, which is the top of the monthly Ichimoku cloud. That is a huge level of resistance that will be plugged into some algorithms to get people to sell at that level, and it could be a really sticky level. Remember as well, when you get to these kind of big resistance or support levels, in this case obviously it's resistance, the markets tend to do one of three things. They either shoot through it, they reject it completely and trend lower, or they shoot through it and trend higher, or they just oscillate around there for a while. And we do think that kind of 87 is going to be a key level that could push us lower in euro sterling. So just just at least attract some decent selling interest at that level if we do manage to sustain gains from here. Currently we're trading around about that 86.50 level. Now I also want to show you the Aussie. The Aussie had quite an interesting morning. It's had, obviously a torrid time of it really since May, since mid-March when it peaked. It really has fallen very, very sharply, and we think there could be further downside to come. Basically, yes, it's had, it's moved 12% against the dollar already. We think there could be another kind of, we basically think that it will lose that point, that 90 handle, and it will get down to those kind of it will move to the 80 handle in sometime soon. Now just bear with me, I'll push it up on this chart. As you can see, yesterday we have bottomed around about 90.50, and we're having a nice recovery, but there is, as always, with these things, there's a lot of kind of resistance on the way up. 92.50, 92.90, and then the 21-day moving average comes in at about just below 93. So that could certainly thwart the upside in the short term. Right. So far today, 92.50 has capped the upside. So we're currently trading around. 91.50 has traded the upside. So we're currently trading around about the 91.30-ish mark. Just as the market tends to be a little bit directionless today, just trying to kind of take stock. But obviously that fall in bond yields, that rise in stock prices, that fall in the dollar, all very good news for the Aussie. And when you get a risk on day, that does tend to be good news for the Aussie as well, because the Aussie is is at the risky end of the FX spectrum, and it's helping to just picking that up. The other thing I want to show you, which is important, has some bearing on the Aussie price, the commodities price index. As you can see, commodity prices are also coming back, and they're a bit of a key driver for the Aussie. So do watch out for that. So in terms of is this going to be, we could get above that 21-day moving average. Let me just go back to this chart quickly. We could get above here, so we get above that 93 level if we get a dovish Bernanke on, because then I think there'll be a bit of recalibration, just shaking out some of those shorts, and could get us, a bit of a steeper recovery. But it all will depend on Bernanke, and it all will depend on these levels. So again, if we get above 93, it kind of opens the way towards basically towards 95 in the Aussie. And some people will say, well, you know what, it's sold off so much already. We still think gains will be capped because it does look like the RBA is going to be cutting interest rates potentially as soon as next month. Some people had expected it later on in the year, but I do think, you know, obviously you look at Bernanke, if he's more dovish than expected, then we could certainly see a nice push higher in commodities. This is the commodity index, obviously being boosted by the better tone to oil and the better tone to gold in the last couple of sessions. And that could have some bearing on what the Aussie does next. Now, it's currently trading at 282, 284.91, so just below 285. That is a key resistance level on the 50-day moving average, so it'll be interesting to see if we push up to there. Obviously, though, it's an index, so sometimes moving averages can be quite difficult to track, but there we go. Now, the last major I'm going to go through is going to be dollar yen. Obviously, dollar yen, having a nice recovery there. As you can see here, this is the daily chart continuing its recovery, looking really, really nice, very smooth recovery, and not too volatile, not like Treasury yields, and we backed off from those 101.50 highs, but we're finding very, very good support. This cluster of hourly moving averages, which come in just about 101. Obviously, on the downside, we're looking here, 99.50, which is the 55-day moving average, should act as more kind of longer-term support if we were to break below that one kind of 100 level. But we're looking pretty sound above 100 for now. As I said, probably trading sideways a bit. There isn't too much economic data to move us one way or the other, and we could see us moving sideways actually until we get those FOMC minutes. Now, if we were to get if we were to get back to those kind of 101.50 towards 102 highs, there is a risk that we could sell off at this Bernanke meeting, but and the FOMC minutes, and Bernanke speaking later. So remember, it's all, this pair is going to be really driven by US events, by Fed events, by those FOMC minutes released tomorrow at 7 o'clock London time, by Bernanke's speech on Friday as well. So do watch out for all of that, because that's going to have a big impact. But as I said, right now, 101.50 capping the upside. As I showed you, this kind of cluster of daily moving averages at 101, certainly in the short term, capping the downside. And then in the slightly longer term, it's a 55-day moving average that comes into view at 99.50. Okay, Pan, you want me to look at CAD? I will do that. This is just dollar CAD. As you can see, dollar CAD, again, looking pretty similar to dollar yen. It's been moving alongside, moving very much alongside what the dollar is doing, being boosted by that stronger dollar as well. 105.50 in terms of how significant is this? It is significant. We did get above. We got 106.10 last week on the 5th, so that was on the day of the payrolls. The payrolls had a real positive impact on dollar CAD, and this is partly because Canada also released its employment data, and it was kind of weaker than expected. There was employment fell. Full-time employment was down as well. Participation rate was slightly stable. It just wasn't nearly as exciting as the non-farm payrolls report. So, 106 is obviously massive resistance, and we've just backed off from there as well in the last couple of days, so at the start of this week. In terms of where CAD will go next, it's going to all be dependent on Treasury yields and these FOMC minutes. Now, I know some of you will be technicians and won't really look at fundamental data, but it is always worth keeping it. Why just be so dogmatic to one thing? Why not take the best bits from both? And those FOMC minutes, even though some people say, they're not going to be too market moving. We had a press conference last time. I disagree. I think they are going to be very market moving, largely because we're going to have a lot of dissecting going on, as I mentioned, a lot of analysis of, the Fed's tapering program. That's going to be absolutely key. So, as you can see as well, just on the shorter term chart, we are finding a little bit of support here at 105.40, and then below there you get kind of 105, just below 105.30. So, a lot of support on the way down for the CAD. For now we could just trade sideways, as I said, just below 106, acting as very good resistance, and then on the downside, kind of 105.30ish. So, trading in a fairly tight range, 70 pip range, potentially as we lead up to that, to those FOMC minutes tomorrow. Now, I have time for one more question, if anyone would like one. or if anyone has a question, please write it in the chat box. Ray, thank you very much. You're always very complimentary about the analysis. So I'm guessing there's no more questions. Well, that's great. Thank you all so much for joining. I hope this has been useful. And is oil at a higher? Okay, Pan, I'll just quickly answer that about oil. Is that at a higher than expected price? This will be really dependent. I'm going to look at Brent purely because we're open. I'll also look at WTI quickly. But as you can see, it's not really at a higher than expected price. I mean, you know, it's in terms of, you know, Egypt tensions are flaring. You know, that would always increase the premium of the oil price. You know, as you can see here, though, gains do tend to be capped at this 108.50 level, which is also the 200-day moving average. So, you know, yes, it's high relative to its performance in the last 3 months, but what we've seen is a different fundamental backdrop now. What with geopolitical risks coming up from Egypt, that there's obviously, you know, fears are running a little high about Egypt, but they're not going crazy. Otherwise, we'd be back at 120 like we were in the Arab Spring in 2011. So instead, we're seeing gains capped here at 108.50. If we do get above 108.50 in Brent crude, then that would be a very bullish development. In terms of WTI, just grab it. Oh. WTI has actually had, like, you know, real push higher, and I guess maybe that was what you were looking at. But yes, I mean, it's, you know, like fresh, you know, yearly, annual highs or multi-month highs now. We're at the highest level really since kind of, you know, over a year and 3 months. And, you know, why? Well, there's a couple of things. Supply and demand as well. Supply is fairly tight in the US at the moment, which reverses a lot of kind of, you know, the multi-years really, where we had some very a problem with oversupply of WTI crude. So supply is being whittled down, and that's also putting up the pressure, along with the fact that if Europe can't get its oil from the Middle East, then it will have to get its oil from the US, from WTI. So, you know, that's one of the reasons. Obviously, as tensions flare in Egypt, expect oil prices to go up, both Brent and WTI. As things calm down, expect it to retreat. Now, I just want to show you one last chart, because WTI has really been outpacing Brent. So this is just the spread between Brent and WTI, as you can see here. It's been really narrowed. I mean, it's at some of its lowest, the spread between them. So Brent is still trading at a $4 premium, $4.3 premium to WTI, but it had been as high as $25 in October last year, as high as kind of, you know, just below $25 as recent as February. So, you know, this is kind of unusual. You know, it's one of its lowest levels since 2010. So, you know, for us, WTI obviously had the bigger move. So if things calm down in Egypt, then it could come off the hardest, basically. Okay, everyone, thank you so much for joining. Please do join us next week for more, and good luck trading today.